Welcome back, everyone. On today's episode of The Joseph Carlson Show, we're going to be going over 3 companies I believe will outperform the S&P 500. Now, I'll be explaining why I think they'll outperform, and we're also going to be looking at their fundamentals. Before we jump into that, I want to give one quick important note. Today, it shows in my portfolio that I only have $20,900 of gains. Now, if I filter by the one day, I'm down $18,900, which is 5.61%. This is a lie. This is not accurate. And if we look further at what's causing this, you can see the culprit is in the core pie. I'm down 20% just today. Well, if we look right here, we can see that the ETF SCHG, which is a large cap growth ETF, it's down $16,600 or 50%. in one day. This is obviously not accurate. Now, even if we look at Seeking Alpha, it reflects the same thing. It's down 50%. So let's go ahead and investigate a little further. Here's what's causing the issue. If we look at the stock split history, there is a stock split March 11th, 2022, which is exactly today, and it's a ratio of 2-to-1, meaning that every single share of SCHG is now worth half as much, but you're going to get twice as many. So this is obviously just a data issue. A number of ETFs from Schwab had a 2-to-1 stock split, and some brokerages take a day or two to update that, and M1 Finance is one of them. So over the next couple of days, this will be updated, and the $16,600 of losses will go away, meaning that overall I'm really in the green by around $38,000, not $21,000. Now, having said that, let's go ahead and jump right into the 3 companies I believe will outperform the S&P 500 over the next couple of years. The first one is a non-dividend paying company, and it's Google. Now, before you get upset, hear me out. I want to explain a couple key things with this company. First of all, because companies are big and they're well known and lots of investors have looked at them, that does not mean that they're accurately being valued. This has been proven time and time again. Many of the biggest companies in the world have remained undervalued for a very long period of time, and I still believe that Google is one of them. Let's go ahead and look at some of the fundamental data here using Qualtrim Insights. And Qualtrim Insights is this website that you get access to if you join the Patreon. So it's included in the Patreon. You also get a free trial. So if you want to try this out, I'll leave a link in the description below. Now, what we can look at is first the valuation of the company. Google's a big company. It's at $1.75 trillion, but even at its staggering market size, it trades at a 23.5 Forward PE ratio. While the rest of the stock market, every single company, all 500 of them, have an average estimate of 19.25. That's the forward PE ratio of the S&P 500 overall. So right there, another way of looking at this is you can either buy the S&P 500 with a 19 PE ratio or Google with a 23. So you're paying a very minimal premium to buy a company that is leaps and bounds better than the average company in the S&P 500. Now, the first thing that we can look at is this revenue chart here. Google is a fast-growing company, and it's grown fast for year after year after year. The growth did accelerate quite a bit over the pandemic. So that was kind of a one-time boost. That's something that's probably not going to be replicated over and over again. But overall, Google didn't rely on the pandemic for its growth. This company isn't like Zoom. It's not like Peloton. It's not one of these pandemic plays. YouTube is a company that's going to continue to grow with the pandemic or without it. It's not something reliant on it. And of course, the revenue growth will be declining over the next couple of years, but that doesn't really matter. This company is going to continue to grow overall. Combine that growth with the fact that the profit margin is 30%, and you have a company that not only revenues a ton of revenue, but it keeps a huge portion of that revenue. Google's so good at turning its revenue into profits. That is return on invested capital. That's what Terry Smith calls a good company, one that can turn its revenues into profits way above the level of its cost of capital. And with margins of 30%, Google is an incredibly profitable company. So with those high margins, Google's a company that doesn't only grow its revenue, but it also takes a lot of that, it turns it into profits, and we can see this in all the proxies for their earnings. EBITDA as an example. This is their earnings before interest, taxes, depreciation, and amortization. We can see that Google was growing their EBITDA somewhat over the past few years, then the pandemic happened, and that really did help spur growth for this company. The past 4 quarters, they had $24 billion, $25 billion, $26 billion, and $27.96 billion in EBITDA. This is substantial growth. And this really only happens with companies that have significant moats. Now, of course, an important metric we want to look at is their free cash flow growth. We want to see a trend of them growing bigger and bigger free cash flows. Free cash flow is a way of saying the amount of revenue the company makes and then the amount of money they keep after all their CapEx, after paying all of their employees, after paying for all their leases and their warehouses and everything to run the business. How much is left over? Now, again, a lot of this growth in free cash flow is probably a result of the COVID effect and the lockdowns. That did help Google, but I still think they're going to continue to grow it. In my opinion, I don't think it's going to be one of those companies that does a round trip right back to where it was pre-COVID. Now, of course, the last profitability metric we want to look at is their net income. This is the bottom line of the company, and it resembles the EBITDA and the free cash flow, which is what we want a good company to do. We want all those three graphs to look somewhat similar. Now, if we look at the balance sheet of Google, it's somewhat of a joke. They currently have $12 billion in debt. That would be a lot of debt for a normal company, but for Google, who currently has $139 billion in cash, that's not a lot of debt. If we do the math on that, right here it shows us on Qualtrim Insights, that is $127 billion of net cash. This is why Google is a superior company to the huge majority in the S&P 500. While many companies are swamped in debt, they're highly leveraged, and their earnings are being boosted by temporary low interest rates, which are going to change soon, Google doesn't need the low interest rates. They don't need to have debt to fund their growth. They're growing organically, and they're highly profitable. So when we look at the PE ratio of 23 and we compare it to the rest of the market, you have to factor in things like the stability of the company, the stability of the growth, and their balance sheet. Google has, relatively speaking, no debt. $12 billion in debt, $139 billion in cash. This is an incredibly cash-rich company that offers them a lot of different options with acquisitions, and it also makes it so that they have zero chance of going bankrupt. Then we can look at their EPS. This is the earnings per share. This is the net income of the company divided by the amount of shares outstanding. What we can see is that even prior to 2020, prior to COVID, Google was growing their earnings at 15 to 20% year over year. So they had very consistent and fast earnings growth even before the pandemic. Then the pandemic happened, the lockdowns happened, and Google's EPS growth went to like 80% per year. So obviously that was a one-time earnings growth phenomenon. That's not going to be repeated. But even if Google goes back to their normal earnings growth of 15 to 20%, this company is growing, relatively speaking, 50% faster than the average company in the S&P 500. And part of the reason that the earnings growth is so quick is because of their shares outstanding. This is an important metric to look at with any company. If this graph is going up over time, that means the company's diluting you. That means that every share you own is a smaller and smaller portion of the company over time. If this graph is trending downwards, that means that the company is doing share buybacks, and your equity in the company is increasing because there's less shares outstanding. With Google, you can see that the trend is clear. Starting around 2019, with the enormous amount of money that Google makes, they can aggressively buy back their shares. And in 2019, they went from 694 million shares to last quarter having 662 million shares. The average stock that they're buying back is around 2% of their market cap per year. That's pretty significant. Another way to put that is even though Google doesn't pay a dividend, if they were to allocate that same buyback cash to dividends, they'd be paying around a 2% yield, which would be pretty decent. I know a lot of dividend investors that would probably buy Google if they started paying a 2% dividend yield, but they're instead using that cash to buy back their stock, which helps increase their earnings. So in my opinion, looking at the fundamentals of Google, as well as the growth prospects with YouTube and Android and all their businesses that they work in, I would give this company around a 70 to 80% chance of outperforming the S&P 500 over the next 5 years. Anything can happen. It could be disrupted. Things could go wrong. There's always a chance of that. But I think there's a high probability of outperformance. Now, the next company that I'm going to outline is one that I really believe has a very good chance of outperforming is Disney. And I think this one will be a more controversial pick. Now, let me go ahead and explain why. The first thing that we can look at, and the thing that causes the biggest issue with investors right now, is the forward PE ratio. They trade at a 35 forward PE. And as we pointed out, the rest of the S&P 500 is at a 19. So by comparison, this makes Disney look very expensive. Well, I don't think that's accurate. In fact, just looking at the trailing PE, it was 80, and it moved all the way to 35. This was because Disney is rapidly growing their earnings back up to prior COVID levels. If we look at Disney's history and their earnings per share, this paints a better picture. If they're able to grow their EPS by another 50 or 80 cents, this company will be right back to where it was before, and the forward PE will drop substantially. So investors right now are investing on the idea that Disney will be able to grow their earnings back to where it was before. Now, if we look at the fundamentals of Disney, we can bring up these charts and see how the pandemic affected their business. Every single chart shows that there is a dip during 2020, during dealing with the pandemic and the lockdowns of their parks and the shutdowns of movie theaters. Obviously, that affected their business a ton, but most of the charts show a return back to pre-COVID levels. They've already had their revenue surpass where it was back in 2019. Their profitability, however, has not gotten back to that level. The EBITDA is still suffering. They're still trying to return that. The free cash flow has been very difficult for Disney. It was negative last quarter. You can see the same thing in the net income. This was positive, but it's still not anywhere close to where it was 2019. Now, if we look at their balance sheet, Disney's a company that has quite a bit of debt. They had to take on more debt in 2020 to deal with expenses and the lack of earnings, so they had $54.2 billion in debt, but this has steadily declined over the past quarters. They've been paying this back down. Their cash position right now is $14.4 billion, so they do have quite a bit more debt than cash. They run a little bit like a telecom company where they currently have $32 billion in debt. Now, Disney's also increasing their shares outstanding over time, which means they're not doing share buybacks. They're actually diluting the shareholder, but ever so slightly. These number changes are very minor. In fact, I would consider them to be somewhat inconsequential. So overall, when I look at Qualtrim Insights and I just look at the fundamentals, Disney is certainly not as strong of a company as Google, not anywhere close, and the fundamentals don't paint as good of a picture. But there's other things to consider with this company. The first thing, and I think the most important thing that investors need to factor into this investment, is Disney Plus. They now have grown the service to 129 million subscribers over the course of just a couple years. This took Netflix like 8 years to get to, and it took Disney 2 years. So they're growing their service rapidly, and it does have international appeal. Disney's growing in every part of the world. Disney just released a new teaser for the Obi-Wan series, and I'm telling you, this is going to gain a lot more subscribers. This is going to continue to pull in more and more subscribers to Disney Plus.
It is done. We lost.
Stay hidden. The key to hunting Jedi is patience. Jedi cannot help what they are. Their compassion leaves a trail. The Jedi Code is like an itch. He cannot help it. Where is he?
The world of content creation has fierce competition now. It's not just Netflix or Apple TV or Disney Plus or Amazon Prime. Every single big company is wanting to create the best content they can to get your eyes and your attention. But Disney has a special card they can continue to play. It's called Star Wars and Marvel and Pixar and their Disney animated series. There's no other companies that have these assets, and they'll continue to play these cards over and over again, and it will continue to work. So I think that the growth of Disney Plus will continue at a fairly rapid pace. I think that this is content that the entire world wants to see. It might be inconsistent quarter over quarter because they release content at different times, but overall I only see this number going up. And then with the growth of their subscriber count, they also need to make money per subscriber, which introducing an ad model, which they announced they're going to do, will certainly increase the amount of profitability per subscriber. The ad model has been proven to be highly profitable by other streaming services. The second important thing that I would note is that Disney parks are getting more demand. And I think the fact that they recently removed all mask mandates and COVID mandates will make the demand even more significant, because a lot of people that don't want to mess with the hassle of COVID mandates are now able to go and experience the parks the way that they were originally. So I see the operating income of Disney parks surpassing where it was in 2019, especially because Disney now uses what they call Genie Plus, which was normally an old free system called the Fast Pass. They've converted it into an app, and they've made it so that you have to pay to skip lines. Now, around 40% of the people visiting Disneyland are using Genie Plus. This will increase their operating income like crazy. As much as I don't like this from a consumer perspective, from a business perspective, it's quite genius, and Disney's going to make a lot of money. And the third thing that I'd point out for Disney is the box office is coming back to some extent. HBO Max recently ordered The Penguin, a limited series, because of how well the Batman is doing. It clocked in $301 million plus at the global box office. Now that's a Warner Media movie, it's not a Disney movie, but the point stands that the box office is something people are going to as well. So Disney can leverage their content, putting their big blockbuster movies in the box office and putting other limited series like Obi-Wan on the streaming service. I think that they have more options to monetize than they've ever had before. So even though over the past year, Disney's down 32%, it's underperformed, and it's been somewhat of a painful company to hold, I still continue to believe that this company is going to show a very significant turnaround. And I think that Disney will soon pass their 2018-2019 earnings per share. And when that happens, I think that shareholders will be happy. Now again, like in the case of Google, nothing is guaranteed here. There's no insurance here. The future is unknown. So I would give it around a 70 to 80% chance that Disney will outperform over the next 3 years. But again, anything can happen. Disney could be disrupted or things could go wrong. So keep that in mind. The next one that I'll outline is JPMorgan Chase. I think that this company will outperform over the next couple of years. The only exception that I'd give to this bull case for JPMorgan is if we do in fact go into a very severe recession. That is the one exception, and it is a real possibility. I don't think that JPMorgan would struggle that much during a recession, because they are very conservatively capitalized. I think they have a lot of money to take on loan losses, and I think they'd actually sail through it. But even so, investors wouldn't want to touch financials during a recession. So JP Morgan's a company that continues to trade down because of all these macroeconomic events, because of concerns about financials, and the rising possibility of the US entering a recession. But if we look at the valuation of the company, it's now at a 12.9 PE. That's very low in historical context. It's below the market average. It trades at a price to book value of 1.68. JP Morgan's valuation continues to decline. The forward yield on the dividend is now up to 3.1. I said that I'd look at reinvesting more of my money back into this company if the forward yield climbs to around 3.5%. And I still may do that. So it's getting closer and closer every single week, and I might start buying this company if it continues to downtrend just a little bit further. If we look overall at JP Morgan and the fundamentals of this company, it is incredibly strong. And even the fundamentals on Qualtrim Insights don't relay how strong of a position this company's in. They have a diversified revenue stream between 3 different major branches of their company. One of them is Chase Bank, which has all their credit cards and their deposits from consumer accounts, and that's all their consumer banking. Then they have commercial banking and investment banking, and then they have their trading floors. JP Morgan manages trillions of dollars. So that diversified revenue stream brings stability into their revenue numbers. And that's why you can see it so consistent, slowly growing over time at a very low rate. The EBIT is not something we look at with banks because that's their earnings before interest, and interest is key to banks. The most important thing we can look at with their earnings is their net income. You can see that it went down quite a bit during 2020, but it's since returned back to normal, and it's actually been growing quite substantially. Last quarter, they netted $10.4 billion. That's pretty incredible. In terms of their balance sheet and leverage, that's always a tricky thing to look at with banks, but everything I've read about JP Morgan is that they're conservatively allocated. They have around 11 times leverage, which is pretty standard in the industry, and they have massive capital reserves. Jamie Dimon refers to it as a fortress balance sheet that is ready for every single eventuality. Now, one positive thing we can look at with this company is their growing dividend over time. Since 2011, they've grown this dividend pretty substantially, and now they're paying $1 per share per quarter. That's a pretty substantial dividend. Now, the earnings per share growth of JP Morgan is also very encouraging. You can see it growing substantially over the past 10 years, and this is a result of how well this bank has been ran. It's really held up well, even amidst all the fintech companies like PayPal and Square. JP Morgan continues to grow despite all of those things. JP Morgan doesn't only do dividends, they also do share buybacks, and they are a company that does substantial buybacks. So they went from 3.6 billion shares outstanding in 2017. Their latest quarter is 2.9 billion. So they got rid of 700 million shares over the course of the past 4 or 5 years. That is incredible amounts of buybacks. They are devouring their share count. So again, JP Morgan's a company that you have to look at through the lens of probabilities. If we don't go into a large recession in the next 2 years, JP Morgan is undoubtedly undervalued. The fundamentals say that this company is undervalued. If we do go into recession, the stock will probably continue to trade down as investors move away from financials. So if you look at it through that lens, you can kind of get an idea of this investment. Now, that's my thoughts on Google, Disney, and JP Morgan, and why I think all three of these companies have a very good chance of outperformance. But that is all for now. I'll see you in the next one.